Hey everyone, and welcome back. I bet you're all hitting the books pretty hard, especially with those finance exams coming up.
Yeah, for sure.
So today we're diving into a topic that you're definitely going to see on those tests, stockholders' equity.
Absolutely.
Now, it might not sound the most
Oh,
exciting at first,
I see it.
but trust me, it's super important for understanding how companies actually work,
Yeah,
how they grow, and how they're valued in the market.
that's right. It's like, it's not just about passing exams, though, which
Right.
is a nice little bonus,
Right.
but it's about getting that real world financial edge.
Yeah.
It's kind of like being able to peek under the hood and see what a company is made of,
Yeah.
and maybe even get a glimpse of where they're headed.
I like that. Like you can see their DNA and predict how they're going to behave.
Absolutely. And you know what else? This deep dive is brought to you by Grade Guru,
Oh, that's right.
where you can find practice exams and a full summary to help you ace those exams. You can find it all at gradeguru.nl.
Perfect. So let's break it down. When we talk about stockholders' equity in the simplest terms, it's really all about the owner's stake in a company.
Right.
It's what's left over after all the bills are paid.
Exactly.
Think of it like this. Imagine we're starting a lemonade stand and we need money for lemons, sugar, maybe some cups.
Right.
Those are our liabilities. Then we make some money selling that delicious lemonade. That's our revenue.
Revenue.
And what we have left over after we've covered our costs is our profit or our equity in the lemonade stand.
I love the lemonade stand example. That's perfect. It really all boils down to ownership.
Okay.
And in the world of big companies, stockholders' equity is made up of several key pieces.
Okay.
We're talking about things like contributed capital, retained earnings, and sometimes this kind of tricky thing called treasury stock.
Mm.
And each of these tells a different part of the story about how a company has built its equity.
All right, so let's tackle these one by one.
Okay,
Let's start with contributed capital.
let's do it.
Now, this one sounds pretty straightforward. It's basically the money that shareholders put directly into the company.
You got it. It's that initial investment that really forms the foundation of ownership. You see, when a company issues stock, they're essentially selling little pieces of themselves to investors
Yeah.
in exchange for cash. Now, the most common type of stock you're going to see is common stock.
Okay.
This gives shareholders voting rights
Okay.
and a claim on the company's profits.
So it's like buying a ticket to a show and then you get a say in what happens on stage.
Exactly. Now, some companies also offer what's called preferred stock.
Okay.
It's kind of like a VIP ticket. Preferred stockholders usually get paid dividends first,
Okay.
but they might have limited or no voting rights. So think of it like getting a guaranteed slice of the profit pie, but maybe not as much say in what kind of pie it is.
I see. So like they get a guaranteed payout, but maybe not as much control.
Exactly.
Okay, so I'm starting to see the different flavors of stock here. But what about additional paid-in capital, or APIC, as it's often called?
Oh, APIC.
I know it's part of contributed capital, but can we break that down a bit?
Yeah, great question. APIC is basically that extra bit of money investors are happy to pay above the stock's par value.
Hmm.
You see, every stock has something called a par value.
Right.
It's kind of a nominal amount set by the company.
Yeah.
Let's say a company issues stock with a par value of $1.
Okay.
But investors are super excited about this company,
Ah.
and they're willing to pay $10 per share.
Wow.
That extra $9 per share, the amount above par,
Right.
that goes right into APIC.
So APIC basically shows how much faith investors have in the company, how much they're willing to bet on its future.
Exactly. Think of it like this. You go to your favorite lemonade stand, and you're so thirsty and you love their lemonade so much that you're willing to pay double the price.
You know what I would?
It's a sign of confidence, right?
Absolutely.
Okay, so let's move on to the second big piece of stockholders' equity, retained earnings.
Retained earnings. I'm ready.
This is where things get interesting.
Okay, I'm all ears.
So retained earnings are kind of like a company's savings account.
Hmm.
It's all the profit a company has earned over time,
Mm-hmm.
minus any dividends it's paid out to shareholders. Companies can use these earnings to invest in the business, pay off some debt,
Right.
maybe even buy back some of their own stock. It's all about how they manage their money to grow and create value over time.
So unlike contributed capital, which is money coming from outside investors,
Yeah.
Retained earnings are generated by the company's own operations.
You got it. It's like a measure of how profitable they've been and how well they've used those profits to strengthen your position.
Hmm.
Looking at changes in retained earnings over time can give you a real sense of a company's strategy,
I see.
your overall health.
But we're talking about building wealth over time,
Exactly.
like brick by brick.
Brick by brick.
But I have a question I keep hearing about companies buying back their own stock.
Yeah.
Why would they do that? Doesn't that seem a bit strange?
That's where we get to that tricky but fascinating world of treasury stock.
Okay.
Our third piece of the stockholders' equity puzzle. And it can seem a little counterintuitive at first, but there are some really smart reasons why companies might buy back their own shares.
Okay. I'm definitely intrigued. So break it down for me. Why would a company buy back its own stock?
Well, one reason is to try to boost their stock price.
Hmm.
When a company buys back some of its own shares,
Huh.
it reduces the number of shares out there on the market. And you know what happens then?
Less supply, higher demand.
Exactly. It's that basic law of supply and demand.
Right.
Less supply, higher demand, price goes up.
So it's a way to kind of manipulate the market, make their stock seem more valuable.
Well, not manipulate exactly, but it definitely can influence things. It's a way for a company to signal to the market that, hey, we think our stock is actually worth more than what people are paying for it. It's like if you thought your lemonade stand was worth $100, but people only wanted to pay $50.
Yeah.
You might start buying back some of your own shares to show everyone that you believe it's worth more.
I like that analogy.
Right.
Okay, so they're basically betting on themselves.
Exactly. Now, are there other reasons?
Yeah. Are there any other reasons why they would buy back their stock?
Oh, absolutely. Sometimes companies buy back their stock to prevent what's called a hostile takeover.
What's a hostile takeover?
Well, if someone is trying to buy up a controlling interest in a company, buying back shares can help prevent that from happening.
Okay.
It makes it much harder and much more expensive.
So it's like a defensive strategy in the corporate world.
Exactly. It's like a chess move.
Right.
And finally, companies also might use treasury stock to reward their employees.
Oh, okay. How does that work?
Well, they buy back shares and then they offer them to employees at a discounted price.
Oh, nice.
As part of their compensation package. It's a way to say, hey, you're doing a great job.
Yeah.
And we want you to share in the company's success.
Okay, so there's some pretty good reasons behind treasury stock. But how does buying back stock actually affect stockholders' equity? Wouldn't it make it go up?
That's what most people think.
Yeah.
But actually, it's the opposite. When a company buys back stock, it actually reduces stockholders' equity.
Really?
Yeah. It's like they're taking a slice of the pie and putting it back in the fridge.
Wait, but I thought the goal was to increase shareholder value.
It is. It is. But it's a little bit of a paradox. When a company buys back shares, it reduces the total number of shares out there.
Right.
This means that each remaining share represents a bigger piece of the company. So even though the total pie might be smaller, each slice is potentially worth more.
Okay, so it's less about the size of the pie and more about the size of each slice.
Precisely.
Okay, I think I'm starting to get it. It's more nuanced than I thought at first.
It is.
But let's talk about the accounting behind this. How is treasury stock recorded on the balance sheet?
Good question. When a company buys back shares, they record that purchase as a debit to treasury stock,
Okay.
which is considered a contra equity account.
What does contra equity mean?
It basically means it reduces total equity,
Okay.
and the credit goes to cash since they're using cash to buy back those shares. So they're basically reducing their assets and their equity by the same amount.
So the treasury stock account basically hangs out on the balance sheet, reducing stockholders' equity, until they decide to do something with those shares they bought back. What happens when they decide to sell them?
Oh, now that's when things get really interesting.
All right, let's hear it.
Okay, let's imagine a company bought back 100,000 shares at $10 per share.
Okay.
That's $1 million going out the door and $1 million reduction in stockholders' equity.
Wow. Okay.
But then they turn around and sell 50,000 of those shares for $12 a share.
Okay, so they're making a profit on those shares.
You got it. They're selling them for more than they bought them for.
Right.
They would increase cash by $600,000. That's 50,000 shares times $12.
Yeah.
They would then reduce treasury stock for $500,000.
Got it.
50,000 shares times the original price of $10, and the remaining $100,000, the profit on the sale.
Right.
That gets added to an account called paid-in capital treasury.
Okay.
It's important to note that these gains and losses from selling treasury stock,
Yeah.
they don't show up on the income statement.
Right.
Nope. They're recorded directly in the equity section of the balance sheet, impacting that overall stockholders' equity number.
So it's kind of like a separate little profit center within stockholders' equity,
Exactly.
tracking how well they're managing those treasury stock transactions.
You got it.
This is so strategic. I love it.
And speaking of strategic moves, there are a couple of other ways companies can adjust their shares without actually changing the total equity pie.
Really?
Yeah.
What are those?
Things like stock dividends and stock splits.
Ooh, I want to hear about this.
Yeah.
But first, can we just recap what we've learned so far?
Yeah, absolutely. We've covered those three main components of stockholders' equity: contributed capital, retained earnings, and treasury stock. We've seen how contributed capital is that initial investment from shareholders,
Yeah.
how retained earnings reflect a company's saved-up profits,
Right.
and how treasury stock can be used for all sorts of things.
Like a Swiss Army knife of equity?
Exactly.
We've learned that it can boost stock prices, prevent hostile takeovers, and even be used to reward employees.
Exactly.
And we've also learned that treasury stock can be a little tricky.
It can.
But it all boils down to understanding how it affects the number of shares out there
Yeah.
and ultimately the value of each share.
Precisely. So are you ready to tackle those stock dividends and stock splits?
Yes, I am. Bring it on.
Mm-hmm.
I'm feeling like a stockholders equity expert already.
I love it.
Well, almost. But I'm definitely getting there.
That's what we like to hear. So let's dive in and see how these tools can shape a company's equity picture.
Okay, let's start with stock dividends. What are those all about?
Imagine a company baking a delicious cake
Okay.
and then deciding to give each shareholder an extra slice from its existing cake.
More cake.
More cake. That's basically what a stock dividend is. The company is using a portion of its retained earnings to distribute additional shares to its shareholders.
Okay, so instead of getting cash dividends,
Yeah.
like a little payout from the company's profits,
Yeah.
shareholders get more stock.
You got it. It's like getting a bigger piece of the same cake. The total size of the cake, the total equity stays the same.
So it's a way for the company to reward its shareholders without actually having to spend any cash.
Exactly.
Smart.
It also shifts some equity from retained earnings to contributed capital.
How does that work?
Well, when a company issues a stock dividend, the value of that dividend is moved from retained earnings to common stock and additional paid-in capital.
Okay.
But remember, the total equity stays the same.
So it's like rearranging furniture in a house.
Yes.
The house itself stays the same size.
Exactly.
Okay, so how is that different from a stock split? Because they both seem to involve more shares, right?
Right. They both involve more shares, but they work in different ways. A stock split is more like cutting the existing cake into smaller slices.
Okay.
Imagine you have a cake cut into 10 slices.
Right, 10 slices.
A 2-for-1 stock split would be like cutting each of those slices in half.
Okay.
But now you have 20 slices.
So the cake itself, the total value, that hasn't changed.
Yeah.
Just the number of slices.
Exactly. A stock split doesn't change the total value of the company
Okay.
or the overall stockholders' equity.
Got it.
It just increases the number of shares and decreases the value of each share.
Okay.
So let's say a company has 1 million shares outstanding with a value of $1 per share.
Okay.
If they do a 2-for-1 stock split,
Right.
they'll end up with 2 million shares.
Right.
But the value of each share will drop to 50 cents.
So it's like making the stock more affordable for people.
Exactly.
Smaller slices, smaller price tag.
Companies often do stock splits to make their shares more appealing to a wider range of investors.
Okay.
You know, this can potentially boost the stock price. It's all about making it easier to buy.
Okay, so it's not changing the fundamentals of the business. It's just changing how the ownership is chopped up.
That's a great way to put it. It's a way to attract buyers without actually changing anything about the business itself.
Okay, that makes a lot of sense.
Mm.
But with all these changes going on with stockholders' equity, issuing new stock, buybacks, dividends, stock splits,
Yeah.
how do we keep track of it all?
That's where the statement of stockholders' equity comes in.
Okay.
Think of it like a detective's report that shows you all the changes in each part of equity over a certain period of time. It tells the story of how that equity cake has been sliced and diced and rearranged over time.
I love a good financial mystery.
Mm-hmm.
So what are we looking for in this statement? What kind of clues can we find?
Well, the statement of stockholders' equity will usually list out all the major players we've been discussing.
Okay.
Common stock, preferred stock, additional paid-in capital, retained earnings, and treasury stock. It'll show you the starting balance for each,
Right.
any increases or decreases that happened during the period,
Yeah.
and the ending balance.
So each of those has its own line on the statement.
Exactly. And by looking at those lines, you can see how things like issuing new stock, buying back treasury stock,
Right.
declaring dividends, and of course, the company's net income have affected the big picture.
Okay, so for example, let's say a company sells some of its treasury stock.
Right.
Where would we see that on the statement of stockholders' equity?
You would see it as a decrease in the treasury stock line
Okay.
because they now own less of their own stock.
Right.
And depending on if they made a profit or a loss on that sale, you'd see a corresponding increase or decrease in paid-in capital, treasury, or retained earnings.
And what about those stock dividends? Where do those show up?
With stock dividends, you'd see a decrease in retained earnings and an increase in common stock and additional paid-in capital. Remember, we're just rearranging things within the cake.
Yeah.
We're not changing the total size.
Got it. So the statement's like a roadmap showing us how a company's equity has evolved.
Exactly. It gives us valuable insights into how a company has been managing and growing its equity, and it helps us understand the impact of different things they do on that ownership structure.
Okay. So this is incredibly helpful. It's like having X-ray vision into a company's financial inner workings.
I love it.
But I have one more question. We've talked a lot about the different parts of stockholders' equity.
Yeah.
But how do we actually know if a company is using its equity effectively to generate profits? We can see how the cake is sliced, but we want to make sure it actually tastes good, right?
You're absolutely right. That's where our final piece of the puzzle comes in. Return on equity or ROE?
Ooh, okay.
But I think we'll save that delicious discussion for part 2 of our deep dive.
Okay, you've definitely piqued my interest.
Yeah.
I can't wait to learn more about ROE and how to really dissect a company's performance.
It's going to be good.
All right. Until then, keep those brains working.
Absolutely. And don't forget to check out gradeguru.nl.
That's right.
They have tons of resources to help you really get a handle on these concepts.
Awesome. We'll see you in part 2.
Welcome back to our deep dive into stockholders' equity.
I'm so ready to pick up where we left off. We covered
Yeah.
so much ground. But there's one thing I'm really curious about.
Oh, yeah.
Return on equity or ROE?
Ah, ROE. That's a big one.
It is. It's one of the most important metrics for evaluating a company's performance, right?
Absolutely. It basically tells us how well a company is using its shareholders' money to make a profit.
Okay, so it's a measure of how efficiently they're using their equity to generate profits.
Exactly. It's like a report card for how well they're managing the money that's been invested in them.
So a higher ROE means they're doing a better job.
Yeah. Generally speaking, a higher ROE means the company is generating more profit for every dollar of shareholder equity.
That makes sense.
Huh.
So how do we calculate ROE?
Yeah.
Is it a complicated formula?
It's actually pretty straightforward. It's just net income divided by average stockholders' equity.
Okay, break that down for me.
Sure. So net income is the company's profit after all expenses have been paid.
Right, their bottom line.
Exactly. And average stockholders' equity is just the average of the beginning and ending stockholders' equity balances over a period of time, usually a year.
Okay, so let's say a company has a net income of $1 million
Okay.
and an average stockholders' equity of $5 million.
Right.
Their ROE would be 20%.
You got it. They're making 20 cents of profit for every dollar of shareholder equity.
Okay, I think I'm getting this. So if we're comparing two companies, the one with the higher ROE would be the better investment, right?
Well, it's definitely a good sign. It suggests the company is using its resources effectively and generating strong returns for its investors. But like with most things in finance, it's not that simple.
Of course not.
ROE is just one piece of the puzzle. You always want to look at other factors too, like their debt levels, their growth potential, and the overall economic conditions before making any investment decisions.
So we're not just looking at one number in isolation.
Right. It's about looking at the whole picture.
So let's say we're looking at a company and their ROE has been steadily increasing over the past few years.
Okay.
Is that a good thing?
It's usually a good sign. It suggests they're becoming more profitable and using their equity more effectively. But again, you want to understand what's driving that increase.
So what are some things that can make a company's ROE look better than it actually is? Like, what are some red flags to watch out for?
That's a great question. One thing to be wary of is too much debt.
Oh, debt. How does that affect ROE?
Well, a company can boost its ROE by taking on a lot of debt. It's like using leverage to amplify returns.
I see. So it's like a shortcut to higher ROE?
Kind of, but it's risky.
How so?
Because debt magnifies both gains and losses. If things go well, the company can make a lot of money. But if things go south, the debt can quickly become a burden.
So a high ROE fueled by debt might be a warning sign.
Exactly. It's important to understand how much debt a company has and how they're managing it.
Are there any other red flags we should be aware of?
Another thing to watch out for is aggressive accounting practices. Some companies might try to manipulate their earnings or equity to make their ROE look better.
So they might be cooking the books.
Not necessarily cooking the books, but maybe bending the rules a little.
Okay.
It's important to carefully read the financial statements and look for anything that seems unusual or suspicious.
So we need to be critical thinkers and not just take everything at face value.
Exactly. ROE is a powerful tool.
Yeah.
But you need to use it wisely.
Got it. So can we compare ROEs across different companies? Like, is a 15% ROE good for every company?
Not necessarily. You always want to compare companies in the same industry or with similar business models.
Apples to apples.
Exactly. A high ROE for a tech company might be considered average for a utility company.
Right. It's all relative.
It is. So let's say we're looking at two companies in the retail industry,
Okay.
Company A and Company B.
Right.
They have similar revenues and assets,
Mhm.
but Company A has an ROE of 15%, while Company B only has an ROE of 8%.
What might explain that difference?
Well, there could be a few things going on. Company A might be more efficient at managing their inventory and expenses,
Yeah.
leading to higher profit margins.
Okay, so even though they have similar revenues, Company A is squeezing more profit out of each dollar of sales.
Exactly. It's all about efficiency.
Huh.
On the other hand, Company B might have higher operating costs, lower profit margins, or maybe they're carrying more debt.
So Company A is like a well-oiled machine, while Company B might be a little bit clunky.
That's a great way to put it.
This is fascinating. It's like we're financial detectives trying to solve a mystery.
I love that. And that's what financial analysis is all about.
Right. It's about digging deeper and understanding what's really going on behind the numbers.
Exactly.
Okay, so we've talked a lot about ROE, but let's not forget about those other important concepts.
Right, yeah.
Contributed capital retained earnings, treasury stocks, stock dividends, and stock splits.
Right. Those are all part of the story.
They all play a role in shaping a company's equity and influencing its ROE.
Absolutely. It's all interconnected. And remember, understanding these concepts isn't just about passing exams.
It's about understanding how businesses work.
Exactly. It's about becoming more financially literate.
And for those of you who are studying for exams, don't forget to check out gradeguru.nl.
Oh, yeah. Great resource.
They have practice exams and a full summary of everything we've been talking about.
A great way to really make sure you understand this stuff.
But before we wrap up this part of our deep dive, I want to leave our listeners with something to think about.
Okay. I like it.
Imagine you're looking at two companies in the same industry with similar ROEs, but one company has a lot more debt than the other. What does that tell you?
Ooh, that's a good one.
What questions would you ask to assess the risks and rewards of each company's financial strategy?
That's a great question. It really gets you thinking about how debt can impact a company's performance and risk. It's a reminder that ROE, while important, is just one piece of the puzzle.
Right. It's all about connecting the dots, thinking critically, and using what we've learned to make smart decisions.
Absolutely.
Well said. I'm excited to continue this discussion in the next part of our deep dive.
Me too. We're going to dive even deeper into these real-world scenarios and see how we can use this knowledge to analyze companies and make smart financial choices.
Awesome. Stay tuned because we're about to take our stockholders' equity knowledge to the next level. All right, welcome back to the final part of our stockholders' equity deep dive.
I'm excited to be here.
Me too.
Yeah.
So, are you ready to put all the pieces together, see how it all works in the real world?
Absolutely. We've talked about the theory, now let's see how we can use it.
Right, because ultimately, we want to be able to use this knowledge to analyze companies and make smart financial decisions.
That's the goal.
So let's do a super quick recap just to refresh everyone's memories.
Too good.
We talked about contributed capital, right? That's the money that comes directly from shareholders. It's got common stock for basic ownership, and then preferred stock, which is like the VIT ticket, plus that AP, which shows how much extra investors are willing to shell out because they're so bullish on the company.
Yep. And we've got retained earnings, which is like the company's piggy bank.
Right, all those accumulated profits. Companies can use those to reinvest in the business, pay off debt, or even give some back to shareholders as dividends.
Exactly. And then there's that fascinating but sometimes confusing treasury stock.
Right, where a company buys back its own shares.
Yep. For all sorts of strategic reasons, like boosting the stock price, fending off a takeover, or even using those shares to reward employees. It's a pretty powerful tool.
And then, of course, we can't forget about ROE, return on equity, which tells us how efficiently a company is using its equity to generate profits.
Right, how much bang they're getting for their buck.
But as you cautioned us, a high ROE isn't always a sign of a healthy company.
Definitely not. Too much debt or some tricky accounting can make the ROE look better than it really is.
So it's crucial to look beyond just the ROE number and consider the context.
Absolutely.
Okay, so now for the big question. How can we actually use all of this to make smarter investment decisions? What are some practical tips for analyzing a company's stockholders' equity?
Great question. Well, first off, you want to look at the trends in each component of stockholders' equity over time.
Okay, so we're looking for patterns, seeing how things are changing.
Exactly. Is contributed capital increasing? That might mean investors are confident and putting more money in. Are retained earnings growing steadily? That's usually a good sign of a profitable company that's reinvesting wisely.
Makes sense. So we're looking for clues about how the company is managing its money and growing its equity.
Right. Then you want to take a close look at what they're doing with treasury stock. Are they buying back shares aggressively? That could mean they think their stock is undervalued and they're trying to boost the price. Or are they issuing new shares, which could dilute existing shareholders' ownership?
Okay, so treasury stock activity can give us some insights into their overall strategy.
Absolutely. And when it comes to ROE, don't just focus on the absolute number. Compare it to other companies in the same industry and look at how it's been trending over time. Is their ROE consistently higher than their competitors? If so, what's driving that? Do they have a secret sauce?
Right, we want to understand what's behind the numbers.
Exactly. And remember, a high ROE can be risky if it's fueled by too much debt. Dig deeper and see how they're achieving that ROE.
So it's all about digging beneath the surface and asking the right questions.
It is. And finally, remember that stockholders' equity is just one piece of the puzzle.
Right. We need to consider other factors like their revenue growth, profitability, cash flow, and how much debt they have.
Exactly. It's like putting together a jigsaw puzzle.
Yes. Each piece provides a different perspective, and it's only when you put them all together that you see the full picture.
Couldn't have said it better myself. That's why financial literacy is so important. The more you know about finance and accounting, the better equipped you'll be to make informed decisions.
I totally agree. This has been an awesome deep dive.
Yeah, lots of great info.
I feel like I have a whole new understanding of stockholders' equity.
That's what we like to hear.
And for those of you who want to solidify your understanding and test your knowledge, be sure to visit gradeguru.nl.
They've got tons of resources, practice exams, and a full summary of everything we've covered.
It's an amazing resource for anyone who wants to master these concepts and ace those exams.
Absolutely.
Well, that wraps up our deep dive into stockholders' equity. I want to thank you for joining us on this journey. It's been a pleasure.
The pleasure was all mine.
And remember, the world of finance is constantly evolving. Keep exploring, keep learning, and never be afraid to ask questions. Until next time, happy investing, everyone.